Costco's share price is experiencing a little bit of a dip here to end 2024 and start 2025. But does that make the stock a buy? Well, not just the price dip. That's not enough information to determine if the stock is a buy. But I will look at more information. I'll look at the company's critical financial metrics like revenue, like operating profit margin, cash flow from operations, return on invested capital. And then I'll compare that against its valuation. And I'll look at valuation not just on price, but I'll also look at the forward price to earnings ratio. And I'll also share with you my discounted cash flow valuation model on Costco stock. So we get various perspectives on valuation as well as several critical financial metrics to consider in this decision. Let's get started. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Costco is one of the biggest retailers in the world at $258 billion in trailing 12-month revenue. What's impressive about Costco is not just the total revenue, but the revenue per store. The Costco total store locations is still less than 1,000, where Walmart is approaching 10,000 or roughly 10,000 stores worldwide. Costco is only a fraction of that, and Costco is almost half of Walmart's sales. So with a fraction of the size, Costco generates almost half of the sales like a retailer like Walmart. Costco does that by getting each customer to spend more money every time they go there and restricting locations so that each location generates a lot more revenue. If you've ever been to a Costco location, I know I've never been to a Costco that hasn't been extremely crowded. It's hard to move around. There's so many people there. All of the cash registers are open and there's long lines at all of the cash registers. If I ever want to return something, there's long lines at the return window. It's just crowded all the time. That's on purpose. Costco could open a new location in an area that's busting open because there's so many people inside, but they prefer not to because that increases the efficiency of that existing location. Costco is okay with delivering that crowded experience because they count on the fact that they deliver great value on price to customers. They offer quality products at low prices, and that's what they count on to keep customers coming back. And so far, it's worked really well. Costco's membership renewal rate is over 90%, even after they recently increased the membership fees on both the standard and executive tiers. Costco's customer value proposition is excellent when measured by how many customers renew their memberships and the revenue growth of the business over the last 5 years and longer. I mentioned that Costco offers great value to customers, and that comes at the expense of Costco's profit margins. At just 3.67%, Costco's operating profit margin is very, very small. And it's been rising to their credit from 3% to 3.67%, but it's still really, really small. Now, brick and mortar retailers in general have small profit margins, but even a company like Walmart is closer to 6%, Target is closer to 8%, and home improvement retailers are closer to double digits, 14, 15, 16%. So for Costco at just 3.67%, it's a low margin, but it's on purpose because Costco doesn't mark up their products by a large percentage. They are okay making a small profit margin on each sale, but they count on the fact that they're going to make a lot of sales. So instead of making 50 cents on every dollar of sales, they'd rather make 5 cents on every dollar of sales, but have you spend so much, so that those nickels add up. That's Costco's strategy, and that's how they've built customer loyalty, is by offering those prices that are not significantly marked up from their value. Similarly, their cash flow from operations has been rising, $9.948 billion in the most recent trailing 12-month period. That's up from around $7 billion in 2020. Remember I talked earlier about Costco's strategy of turning over inventory quickly? That also helps with its cash flow from operations. Oftentimes, Costco gets inventory from its suppliers, sells them to customers, and gets money from customers before it even has to pay back its suppliers. Think about that. So, suppliers, let's say General Mills or some Kellogg's, let's say, sends them cereal and tells Costco, okay, you have 30 days to pay us back or 60 days to pay us back for this inventory that we're sending you. Costco typically ends up selling that inventory really quickly, getting the money from customers, and then using that money to pay back the suppliers 30 days later or 60 days later. This cash conversion cycle is very favorable for Costco, and it's helped the company generate strong cash flow from operations, strong free cash flow, while employing relatively little capital to earn that cash flow from operations. Essentially, suppliers give Costco an opportunity to sell these products before they even have to pay the suppliers. And Costco has earned that privilege from suppliers because they've earned so much customer loyalty that suppliers want Costco to sell their products. It makes them it gives them a higher value to be inside of a Costco, to have their products being sold at Costco. That gives a lot of suppliers more value. And so they're willing to offer Costco favorable terms because they're confident that Costco can turn that inventory over quickly, and then they can send them even more inventory and sell more inventory. So I mentioned that strategy has worked really well, and you can see that evidenced in its return on invested capital, which has been rising steadily for decades. It's in the last decade, it's increased from around 14% all the way to 25.4%. This measures how good Costco is at taking investor capital and turning it into profit. And I highlighted earlier that suppliers give Costco these favorable terms, and this is not investor capital. When suppliers give Costco the opportunity to sell products at a profit before they have to pay them, that's free capital that Costco gets to utilize. It's not coming from investors, that's coming from suppliers. That's part of their business strategy, that's part of their competitive advantage. Not every company gets that privilege, right? If you or me were to open up a brick and mortar store, these suppliers would not give us those favorable terms. Costco has earned that privilege, and that's one of the benefits of having Costco stock in your portfolio. But now let's look at valuation. I've talked extensively about how great a business Costco is, but is it too expensive? Well, if you measure by the forward price to earnings ratio, it is really expensive. It's trading at a forward PE of 45.86. That's about the highest it's been going back all the way to January of 2022. And this is more expensive than companies like Amazon, Nvidia, Microsoft, Apple. It's trading at a more expensive valuation than some very successful tech stocks. But what about if we measure it using the discounted cash flow model? Well, we get a similar answer here too. My intrinsic value calculation for Costco has it valued at $673 a share, while the current market price is $916 per share. So while Costco stock is an excellent business, the valuation is stretched, in my opinion. So if I was to answer, is the stock a buy, hold, or a sell? I would say the stock is a hold because it is an excellent business. And so it's sometimes worthwhile to pay a premium price for an excellent business. In this case, I have it rated as a hold. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.